AI is reshaping our world. It is involved in hiring, firing, coding, and decision making while redefining rules and responsibilities. But who owns AI generated content? Who's accountable for its impacts? How will it impact jobs and society? This course dives into the messy, real world questions about the politics and policy of AI and the people caught in between. Join the expert capsule course in Politics and Policy of AI starting on 13th September. Apply now.
Welcome to All Things Policy, a daily podcast by the Takshashila Institution. We are a bunch of policy nerds based in Bengaluru, and we like bringing fresh perspectives to Indian affairs and Indian perspectives to global affairs. So grab a cup of coffee, sit back, and join us for today's chat.
Hello and welcome to this episode of All Things Policy. I'm Arindam Goswami, your host for today. I work as a research analyst at the Takshashila Institution. Today we dive deep into the heart of global manufacturing. As the world grapples with shifting supply chains, trade tensions, and the race for technological dominance and sovereignty, understanding China's manufacturing powerhouse has never been more critical. From the persistent challenge of overcapacity to the strategic pivots triggered by the US-China trade war, we try to unpack the complexities behind China's rise and what lessons India and the rest of the world can draw from this unfolding story. Whether you're a policymaker, industry insider, or a curious listener, get ready for a fascinating conversation that goes beyond headlines to reveal the forces shaping the future of manufacturing. And to discuss all this, who better to have than Kyle Chan? Kyle is a postdoctoral researcher in the Sociology Department at Princeton University and an adjunct researcher at the RAND Corporation, a US think tank. His research focuses on industrial policy, clean technology, and infrastructure in China and India, and his work has been published in peer-reviewed academic journals, including Current Sociology, Asian Survey, and others. He has also testified as an expert before the US-China Economic and Security Review Commission. He writes a fantastic popular newsletter called High Capacity, which is focused on current issues in industrial policy, technology, and economic competition, particularly in China. He has insightful views on how China has come to dominate key industries such as electric vehicles, solar energy, high-speed rail, and consumer electronics through a sophisticated and multifaceted industrial policy. His insights have been featured in various major international media outlets, including the Wall Street Journal, the Financial Times, and others. So yeah, welcome, Kyle. Great to have you here for what promises to be a wonderful discussion.
Yes, great to be here.
Thanks for being here. So let's dive right in. Before we dive into details, if we were to just take a step back and set the scene, it would be great to have a background on how economic theory thinks about industrial policy as such, right? Because industrial policy is sort of a government intervention. It distorts the free market by sort of taking sides, right? Generally, when we think of governmental intervention in markets, we think it to be necessary only when there's, say, a market failure, like negative or positive externalities, information asymmetry, etc., right? But in the real world, there are considerations of national security, tech sovereignty, self-sufficiency, etc. And these often, dictate economic policy when it comes to what sort of governmental support is deemed feasible. So how has this thinking evolved over the years? And considering that markets are quite often not really that free, and how does that change the ecosystem? And what sort of feedback loops then sort of create a virtuous or vicious cycle? So, like, what are some of the unintended consequences of industrial policies?
Yeah, so these are great questions. And the classical view of economics, of markets, the role of state intervention in classical economics is basically one where less state intervention is better, where markets can, transactions between, say, two parties can not only benefit each party, but can lead to this broader sort of ecosystem of buyers and sellers that where each may be serving its own interests, but ultimately benefits the whole system. So this is sort of the magic of Adam Smith, the invisible hand. And in many areas, this is true. But one area that economics struggles to grapple with is what are called externalities, as you mentioned. That is the effects of a, say, bilateral deal between a supplier and a customer, for example, may have spillover effects to other players in the industry, to other industries, to sort of economic growth and development and sort of social outcomes as well. So this is an area that I think up until now, classical economics has not really internalized fully. And industrial policy can play a useful role in dealing with some of these externalities. So, a classic example is when you have a large, complex global supply chain that is dependent on particular segments, on particular components or materials. So, right now, we have in the news China's production of rare earth magnets. This turns out to be, in and of itself, not a very large market or a very large industry. In terms of sort of immediate profitability for players in the industry, it's not great. There's also very high environmental and social costs involved with this. But what's interesting is if you disrupt this small part of the broader global supply chain, it has all these downstream repercussions into areas like automotive manufacturing, even to military arms. So, this is an example where the classical economics view, I think, fails to really capture something that the industrial policy effort might be able to fix, which is dealing with the broader sort of almost system level effects of some of these individual actions.
Right, and since you brought up the Chinese industrial policy when it comes to rare earth minerals and all, there's an interesting point there, right? I mean, isn't it amusing that China claims actions against it are anti-market, but while it's the one that's not really upholding the principles of free trade, right? So in reality, China's use of subsidies, currency manipulation, unfair trade practices, and many other such policy instruments create a lopsided relationship with the world, right? That itself qualifies as a market failure. So its playbook is sort of like in the phase one, it floods the market with heavy subsidies, currency manipulation, and all of those things, which leads to artificially cheap goods, global competitors exiting, and then market concentration in China. And then in the phase two, it exploits the same dominance. It uses this market power for geopolitical leverage, maybe export restrictions and artificial scarcity, which then leads to strategic dependence. So this rare earths case study is really telling, right? I mean, it has all those market failures here: information asymmetry, negative externalities, market concentration, and this repeats across industries, solar panels, pharmaceutical APIs, maybe, and you name it, and it's there, right? So this
Exactly.
overcapacity has been a persistent theme in discussions about Chinese industry. So what are your views on this?
Yeah, yeah. So, I mean, I think you have it exactly right. So, I mean, the irony here is that, at least in media and speeches, you have Chinese government officials claiming that China is now, especially in the age of Trump's tariffs on much of the rest of the world, you have China claiming to uphold the mantle of sort of free trade, an open and rules-based international trading system. The reality is very different, right? So, all this time, I would characterize China's approach not as an embrace of free markets, an embrace of sort of global trading, but trying to, in every step of the way, create a bias in favor of China. Whether it comes to attracting foreign direct investment or setting up and requiring joint ventures with foreign companies that want to operate in the Chinese market, whether it comes to Chinese companies moving outwards and sealing up materials deals, say minerals, mining, production from DRC to Indonesia to all over the world. I mean, these are all not so straightforwardly sort of free trade, free market moves by any means. So what you have is, yes, in many areas, very heavy state intervention. In some cases, it's directly through state-owned enterprises. So I mentioned mining. Some of the largest players in China's global mining activities are state-owned enterprises, whether you're talking about lithium, cobalt, nickel. And so, what's important here to note is that, as you mentioned, this does produce sort of structural recurring problems, patterns that we see time and again. One of those is overcapacity, which we're seeing right now, actually, in a number of industries like electric vehicles. But it's been a longstanding issue. You go back to steel, solar panels, polysilicon production, graphite, perhaps. So you also have so this is a result in part because of Chinese state intervention with industrial policy. You have sort of a surplus of resources being thrown at this issue, almost the opposite problem of what countries like the US face, where they don't invest enough in some of these critical components of the supply chain. And you get, in a way, too many players investing too heavily, chasing non-economic goals, right? A lot of these are, in many cases, politically motivated. The central government has some national goals, and the local governments are trying to align themselves with that. that. And they think that one way to do that and produce jobs is to, support their local champions, their local battery makers, their local EV factories, whether or not that's really economically viable in the long run without support. And so you get this, buildup of, competitors that sort of won't exit the market. A flood of increased production capacity, and in what we're seeing right now, sort of a race to the bottom in with price wars, for example, and sort of all these tricks almost to deal with this issue. In the meantime, you have many of China's trading partners complaining about this very problem from the EU and the US, India, for many different countries around the world, the global South, definitely.
Right. And in spite of this overcapacity problem that's there, and there's a lot of wasteful expenditure that's been done that probably they are realizing right now. In one of your high capacity newsletters, you had one of the posts was on Chinese industrial maximalism that you've written about, right? China, where you and I guess Lu Feng made the point that China needs more industrial development, not less. This ties in, I guess, neatly with the GPT, general purpose technology diffusion theory of Jeffrey Ding also, right? So basically, as you guys have argued, the larger and more diverse a country's industrial system is, the faster will be its technological advancement, and that is what it still requires in spite of the overcapacity. And then also there's the geopolitical advantage of China's industrial base, which provides it some bargaining power. This bargaining chip can also backfire, as you guys have written. So how should
Yes.
countries approach this geopolitical perspective of industrial power? Should they approach it with some caution? On these 2 points, Chinese industrial maximalism and the geopolitical aspect.
Yeah. So that long Q&A with Lu Feng, I found so interesting. Partly because at a time when you have so many trading partners with China complaining about overcapacity, complaining about industrial overproduction, you have someone arguing the exact opposite, that China should double down on more manufacturing, on broader manufacturing, obviously trying to move up the value chain into higher tech, higher value sectors, and also making this argument that it has a geopolitical advantage in doing so. That not only does manufacturing bring in revenue, GDP growth, jobs, and not only does it actually help you with technological innovation if you're sort of involved deeply in process innovation, for example, but also that it allows you to have almost, I think in Lu Feng's, in that piece, he compared it to China's version of oil, where so China doesn't, it has a choke point with as it relates to oil, but tries to kind of flip the logic on its head when it comes to manufacturing, that the world is so reliant on low cost, relatively good quality Chinese manufacturing, that it becomes difficult, for example, for Trump to impose tariffs on China and try to shut out Chinese goods, because that would backfire and hurt the U.S. economy. But yeah, so one thing that's very interesting here is that China is not the only country thinking about industrial policy. And in fact, a lot of other countries are pursuing industrial policy in a big way now, in a way that I think marks almost a global pendulum swing from the 70s, 80s deregulation, Reagan Thatcher era, which was a global wave in many ways, towards a reevaluation of the use of state intervention, at least in a targeted sense, to help bolster these areas of, say, high supply chain risk, right? So we're thinking about the COVID time when things like semiconductors were not flowing freely around the world, but also China itself is one of the risk factors that a lot of countries are thinking about, right? So as the US is trying to implement industrial policy on its own, it's thinking about, for example, the CHIPS Act and its huge investment in building up within US semiconductor manufacturing, trying to bring in players like TSMC, Samsung to build factories for semiconductors in the US, in part in response to fears around Taiwan and potential Chinese military escalation around Taiwan. So, in other words, these are all interlinked. It's not only that industrial policy has become sort of more popular now, but partly it mirroring what China's doing, but that China itself is one of the key driving factors behind other countries trying to bring back or reshore some of their manufacturing.
Right, right. And since you mentioned US and like other countries also having their versions of industrial policies, recently the US Department of Defense, right, acquired a stake in MP Materials, which is a company that works in the rare earth minerals sector, right. The CIA has had a venture capital fund, I guess, in QTEL for quite a long time, right. So
Mhm.
there's this way of providing support to companies also, right. So how does it work for countries that don't have as many resources as the US, say like India, right? I mean, this is not really a very feasible policy for maybe a country like India, and maybe other developing countries also, right? So, what is your take on this sort of industrial policy? Where does it fit in? Who all can go for it?
Yeah. So, I mean, one funny thing is actually in the US, a lot of the policy discourse is actually about the US's own limited fiscal capacity for engaging in large scale industrial policy. Yeah. So, ironically, although the US is a rich country, has a lot of resources, has a very wealthy and booming private sector, and some of the largest tech companies, for example, in the world, I think NVIDIA just hit $4 trillion of market cap. Um, Oddly enough, the actual fiscal firepower of, say, the federal government in giving out resources is actually fairly limited, and it's very politically limited, right? There's just a general aversion in the US towards taking, say, a national stake in a company. And that's why MP Materials was in many ways so striking, right? Many times you might have a loan guarantee backed by the US government, backed by some government entity like the Department of Energy. But very rarely do you have like an InQtel style, almost VC stake in some startup, much less a larger scale, established company like MP Materials. So that part is very interesting. I think a country like India faces, I mean, like many countries, faces fiscal constraints, needs to think about where to balance, how to allocate limited resources. One thing that India has, though, that the U.S. doesn't have so much, is that you do have a lot of state-owned enterprises, state firms in India that do control some of the important sectors of the Indian economy, for better or for worse, right? So they have a mixed reputation. In some areas, they're seen as they are in China, maybe being less efficient, less productive, less innovative, and ultimately, holding a monopoly. You think about areas like coal production or things like that. I had done a lot of work on the railways in India, which is a famous key backbone for the whole country, but in many ways faces its own sort of internal bureaucratic barriers as well. So it's a double-edged sword because on the one hand, yes, it can slow down some progress in some areas, but on the other hand, it does give the government a special kind of leverage that isn't just about spending more money, which again, many governments now are careful about. So that could be one area. I don't know if India would necessarily want to follow some of what China has done. In many ways, actually, India has quite a strong presence internationally as well, through investments, across South Asia, across Asia more broadly, across East Africa as well. So there are sort of parallels here, I think, in some of what China has done and some of the Indian sort of geostrategic response to rising global risk in supply chains.
Now, since you've brought out India's state-owned enterprises as such, while the governments generally in India have a lot of liking for state-owned enterprises, statist approaches there in India, but none of these state-owned enterprises are known for maybe their R&D or their innovation, right? So in that context, I had a question as to whether an industrial policy requires a broader ecosystem to be successful in, because does it require, say for example, a good R&D ecosystem, companies investing in R&D? India, for example, doesn't have a lot of private sector R&D coming in, right? You don't see a lot of that, while the governmental or public sector R&D investment is quite a lot, or on par with maybe some of the other countries, but not a lot of private sector R&D. So, and the reason I'm asking this is we've had in India PLI schemes, production linked incentive schemes,
Mhm.
and all in the electronics manufacturing sector, and that has helped in increasing the exports and the production of mobiles maybe, but that hasn't really contributed to an increase in the innovation that you see coming out of these industries, and that probably has further feeding in effect into maybe export competitiveness and further growth, right? We don't have that export outlook. So how important do you think is this external orientation towards export markets, towards R&D? How do all these factors matter when it comes to making an industrial policy successful?
Yeah, this is a great question because the R&D factor is so crucial and I think under discussed when it comes to China's progress in its industrial competitiveness. So in the Chinese system, in many industries, you have very tight linkages between, say, university departments, government research institutes, whether they're connected to the Chinese Academies of Sciences or other sort of central or provincial level research institutes, as well as private industry players, as well as state-owned enterprises. So you have this sort of mix, and all sort of tied to, in many cases, local government supporters, state bank loans. So you have this kind of nexus of creating this broader R&D ecosystem that leverages and sort of like mutually upgrades scientific knowledge across an entire industry. So I'll give you an example. In batteries, right now, China is very dominant in producing lithium batteries, especially lithium iron phosphate batteries, which are now becoming sort of the standard for many electric vehicles. And the question, though, is whether this will always be the case, because it wasn't so long ago when it was a different sort of battery chemistry paradigm, like nickel, manganese, cobalt. And so they're always looking to the future, and they're always worried about being undercut by, say, some new technological development. So right now, there's a huge investment in solid-state batteries, sodium ion, new battery chemistries, and there's an effort underway through an industry consortium where Chinese policymakers are trying to bring together various industry participants, thinking about standards, trying to share some of the R&D work together, so that China as a whole can stay on the cutting edge. So that's one example. India is interesting because you do have a lot of top-tier academic institutions. You also have some very innovative and fast-moving private firms. We've talked about some of the state enterprises already, and then you have some local governments that I find quite responsive. I'm thinking about especially where some of the PLI schemes have taken off with electronics manufacturing in the South, Tamil Nadu, Karnataka, to mention a few, Gujarat, obviously, for other areas like auto or pharmaceuticals, perhaps. But yeah, there's a question here whether India could take more advantage of the assets that it has to try to not only boost the sort of overall spend on R&D for a target industry, whether it's electronics or electric vehicles or something else, but also to try to bring together these actors more and create these kind of cross-player synergies. I mean, I didn't even mention yet the large conglomerates like the Tatas of the world that could play a very strong role in this. So yeah, there are some, I would characterize it as like potential areas for a lot of growth if there could be more of a joint effort, I think.
Right, right. And since you mentioned the local governments in China, right, in India, it's also a fact that in China, the local governments do a lot of investment or provide a lot of support for industries and startups, right? And this is not just at the provincial level, but also at the city level, right? So that you don't see in India. The states are probably doing a lot, but not at the city level, right? We don't have a lot of the city governments doing it. So do you think that's a model that's really worked in China, or has that caused a lot of wasteful expenditure? And if it has been a beneficial one, can it also be replicated in India? And if at all, how should we adapt it here?
Yeah, that's a good question. I mean, yeah, in China, it's been both. It's been both very wasteful, but also very successful. And so you have, yes, especially, not just provincial governments, but municipal governments. The city of Shenzhen was absolutely crucial in building up BYD's capabilities in, for example, providing BYD with local government procurement contracts for electric buses and the local taxi fleet, with providing direct financial support, obviously, to basically kind of being the champion and chief sort of sales agency for BYD across the country, and then later on that helped it sort of advance to the global stage. So I think that it's very interesting to see how active a role local governments play. You have other places like Hefei trying to build up their own EV capacity, offering various incentives. And crucially, it's not just about throwing money at the problem, but I think one thing that's almost unique about the Chinese case is the extent to which local governments, again, provinces, municipalities, are very proactive in trying to help companies cut through red tape, get sort of permitting, streamline different kinds of bureaucratic processes that in some ways are almost more valuable than just getting more tax credits or more tax abatements, and that frankly are also less costly, right? Because you're again talking about less debt, less fiscal strain. So yeah, the question is whether India can replicate this. One tricky thing is that India's political system is differently structured, and I'm not just talking about sort of like democracy versus authoritarian, but the nature of sort of political power in my mind, really sort of is concentrated at the state level in India. And cities do not have as much sort of independent authority to not only make decisions but sort of deal with land issues. I mean, land is so huge. I could spend many hours talking about land alone because that is both a huge sticking point, obviously, for Indian industrial development and infrastructure development in many cases, and as it is in the U.S. and frankly many other parts of the world. And it is also one of the key sort of advantages that China has, where local government control of land is important, but also local government is incentivized. And this is the other big thing. Because they essentially control land in their jurisdiction, they want land values to go up. They're highly incentivized to build up new industrial parks, to incentivize firms from outside of their area to come invest, not just to produce jobs, but it also raises the value of the real estate, and helps with the local GDP growth. So I think these are some things where, yeah, it is a different sort of political system. And at the same time, I mean, there are some things where I see some proactive efforts, whether you're talking about interesting things in Bangalore or Hyderabad, where I visited. Yeah, there might be more areas where there's space for local government, especially municipal governments, to play a stronger role.
Now, just to ask about there's this debate in India between manufacturing and services as such, right? But within manufacturing also, there are some sectors in which India would probably have to play catch up now, right? So even there, probably industrial policies may not help, provide that big push that's required to catch up. So should India, as such, focus on some very key sectors and have industrial policies at these targeted sectors, or maybe go for some sectors which are still very emerging, but we think are could probably become important going ahead, right? Just like China did it maybe a decade ago in the batteries and that particular ecosystem, and now it's really it's leading in that, and that it's done vertical integration and all of that. So just wanted to get your views on whether India should focus on some sectors, or also on the traditionally considered important manufacturing sectors like steel and others, right? So your views on that.
Yeah, it's a good question. And India's case, I think, is actually kind of unique. So for other countries like the US, I would say, focus on certain targeted sectors, ones that are either strategically important, have broader economic spillovers, important for national security, but don't try to go after everything. It's a waste of effort, honestly. Similar with the EU, right? The cost of labor is so much higher. It's hard to be competitive. You're really going to be sacrificing a lot, whether it comes to costs or product quality or whatever it may be, or just production volume. India is a different case for two reasons. One, its labor costs are lower. So India, in theory, could be much more competitive. It would make a lot more sense. And number two, India is just a huge country. And I know comes up all the time, but it looks more like China, and in terms of scale, potential scale, than even some of its Southeast Asian competitors like Vietnam and Malaysia and maybe Indonesia, for example, Thailand. So in that case, I actually think that India is one of the few countries, maybe the only country, where possibly Brazil could play this role too, but where I would actually advocate for much broader based manufacturing investment and development, where unlike in the U.S., it doesn't make sense to produce some of these products, domestically. In India, it could in the long run. And crucially here, I would point to China's experience with manufacturing, where a lot of its ability to produce manufacturing sort of more advanced sectors, we're thinking about like all the way going up to now sort of semiconductor chips or advanced battery components, that is often built on the back of an existing larger, lower tech industrial base. So everything from steel and aluminum to, plastic injection molding tools tools, some of these underlying less, sort of eye-catching industries that I think actually underpin China's competitiveness in its more advanced sectors. So ironically, I mean, maybe not so ironically, this is like one of the arguments that Lu Feng had made, and others have made it too in China, where this idea that China should not abandon its sort of traditional manufacturing sectors because they're lower end, lower value, lower skilled jobs, but that it should maintain them because they actually support sort of these higher end industries. I actually agree with that, and I think for India's case, again, it might not make sense for other countries, especially smaller developing countries, and especially for countries where wage costs are just much higher. But in India's case, plus with the boom in infrastructure development in India, I think all that together would make India a formidable competitor in terms of having this at-scale manufacturing. And then the last thing is that right now, this geopolitical moment, I think, is really critical for India. And I know this is talked about a lot domestically within India, but this China plus one moment, I think, has created an opening that may be sort of a once in a lifetime opportunity. And right now, India, needs to seize this moment because whereas in the past, maybe it would have taken a while and been difficult to climb the hill of competing with Chinese low cost manufacturing capabilities and scale and flexibility. Here you do have many countries, many potential customers around the world who are looking to at least find another supplier outside of China, and India could be that case. So I think, the PLI scheme, I know it has had its pros and cons over time. Implementation varies across different sectors, but I do see that if India were to really make this a key sort of long-term national goal, I think it would make sense actually to do much more broad-based manufacturing capacity building.
Right. And in this capacity building, what do you think is the role of state-owned enterprises in India? Because your work has detailed how SOEs remain central to China's industrial ecosystem, right? They drive quite often major projects, but obviously at the cost of efficiency and innovation sometimes maybe. So how do state-owned enterprises still influence China's manufacturing ecosystem, and are they a good model for India to go ahead with? Because right now, even though the current government's slogan has always been minimum government and maximum governance, and they want to sort of in theory move away from statist approaches, but in terms of the idea of creative insecurity, right, which helps you coalesce domestic opinion around a particular idea, and if that idea were to be to enhance the role of state-owned enterprises to provide this push that's required so that India can take benefit of the global supply chains being de-risked and offshoring and offshoring and plus one efforts and all of that, right? So if India were to take benefit of that, what do you think could be some steps that India can take along these lines?
Yeah, so for China state-owned enterprises, it's interesting. Two things are interesting about them that may not be known widely. One is that in some cases, depending on the industry and depending on the structure, you have in many cases quite strong competition actually within an otherwise seemingly state-controlled industry. So I had done previous work on the railway industry and especially on railway infrastructure, railway rolling stock, and it turns out even though this is all sort of basically part of a state ecosystem, state-run ecosystem in China, you do have a lot of different contractors that are all state-owned competing for different bids, and that actually helps to improve or incentivize upgrading of skills, of capabilities, investment in equipment. So I call this kind of a managed competition approach, where it's not a private sector free market approach, but it's also not just having a single state-owned monopoly control everything and then hope that it would make the right investments and upgrade its capabilities. So that's one thing. The other thing is that, kind of going back to your original question, I do think that there was maybe a mistaken idea in classical economics that state-owned enterprises, when they are not profitable, reveal that they are not competitive or high quality. And that might not actually be the case in China because that might not be the goal, profitability, that is. the goal in many of these cases is actually to produce at large supply, a large volume, and at low cost key inputs into the rest of the economy. So, I mentioned again, steel, cement, aluminum, energy is a huge sort of general input into virtually every aspect of the Chinese manufacturing ecosystem, and that's deeply controlled across many layers by state-owned enterprises. And so here, one very important role that these SOEs play is that they help to lower the key input costs for these critical inputs that have much bigger downstream effects. So for India's case, again, I don't know if it's wise or accurate to try to like compare it too directly, but there is sort of a different idea of state-owned enterprises that could be out there that leverages the forces of competition to drive innovation or drive industrial upgrading, while at the same time recognizing that not only is it about control, and for sure in China it is about control, these state-owned enterprises, that is Beijing's control over the economy, but it's also about broader economic competitiveness at a national level. And so, yeah, I often think about the railways, in fact, going back to those in India, where I think for a very long time, the operating leverage ratio was sort of the main yardstick for measuring the Indian Railways performance. And I always thought that was mistaken because it's not about the direct financial return of this system. It's about the broader economic effects that it has on the rest of the country. And so to that extent, it would make sense in my mind to run the Indian Railways at a loss, especially for freight, and to have it be a subsidized component of the broader economy, because the railways are really the backbone, as I mentioned earlier, for so much else within the Indian economy. So yeah, thinking about this again, rather than just zeroing in on whether one state-owned enterprise is profitable or not, thinking about the broader effects of this across the entire sort of industrial ecosystem.
Right, right. And in your own work, you have like just moving to the trade wars, unintended consequences, right? Your own work and in general the literature has shown that tariffs and trade tensions have led to global supply chain disruptions, price hikes, etc. Right? And this obviously has caused both pain and unexpected adaptation for Chinese firms. So in your research, what do you think have been some of the unexpected consequences of the US-China trade war on China's manufacturing strategies? How have they changed? How have Chinese policies evolved in the last maybe decade or so? And where do you see this going, right? I mean, because companies are trying to move away from China, but that's also a little difficult, right? So where do you see the future of made in China as such, right? It's probably moving away from low-end manufacturing. It's possibly reshaping its economic model. But do you see a radical shift in China's manufacturing landscape over maybe the next decade? And would it be scaling back on manufacturing in favor of these other sectors? How does it play out?
Yeah, so I think one sort of like quick line to characterize some of this is a trend from made in China to made by China. That is, you have many Chinese firms going abroad. This has already been ongoing before the more recent trade war and recent tariff escalations. But you had for a long time Chinese companies, moving to places, especially like I mentioned, Southeast Asia, Vietnam, Thailand, setting up supply chains outside of the country, and then even thinking about India as well, and then also thinking about markets that they're selling directly to. So there was even substantial Chinese investment now in Europe, Brazil. It's not a coincidence which countries Chinese investment tends to go to and which countries Chinese firms tend to go to. This is not driven purely, I argue, by commercial interests. That is where they can sell and how they can perhaps get around tariffs, but also driven by geopolitical considerations, where China wants to sort of reward countries for having favorable diplomatic relations. I think about Hungary perhaps being one of the best examples of this within Europe. But yeah, I see in general this sort of expansion of supply chains out of China. However, I do think that what will happen is China will try to retain as much of the core technology and the higher value parts of the supply chain. So even as Chinese firms go out, maybe they start with final assembly, and maybe they start to bring some of their parts and suppliers out into other countries outside of China. I think, like Japan and like South Korea and like Taiwan in a previous generation, China will try to retain, the higher end parts of this supply chain within China and control the core IP. And that will provide the continuing economic benefits so that, yes, they will lose some jobs. But the idea here is, I think, on net, this would generate longer term sustainable economic growth, higher skilled jobs, especially for China's, speaking of overcapacity, China's overproduction of college graduates, of university students these days, even at the PhD level, who are desperate for jobs. So I think that could be a trend that I already see happening, that has been happening actually for over a decade now, but has certainly accelerated, it seems like, in the past several years, with rising efforts, rising tariff rates, rising sort of geopolitical trade uncertainty, and with sort of growing confidence among Chinese firms that they can pull this off and that they could successfully set up say, an EV factory or a battery plant in a place like Morocco, or even Mexico was quite a bold move, or Brazil, or Turkey. So that's something that I will be watching very closely going forward.
But won't that also affect the cost competitiveness of the Chinese industries? I mean, if they are not able to provide the same labor cost competitiveness from factories in other countries, that would sort of level the costs, maybe. I don't know. Will that have a cascading effect on China's dominance, even if it retains the higher end, value added part of the chain?
Yeah, so I think in a world without tariffs, yes, but then in a world without tariffs, I don't think Chinese firms would have been as eager to set up operations abroad. So if you include sort of like if you are operating in Brazil, and you're thinking about Brazilian companies competing with Chinese companies that have built factories in Brazil. Versus Chinese factories in China trying to export to Brazil, but then facing tariffs entering the Brazilian market. So you look at those three different sort of cases, and I see that it may, depending on the tariff rates, depending on the ability for Chinese companies to set up factories in sort of host countries, in the receptiveness of host countries to Chinese investment. And there's, I always say that the devil's in the details with each of these, like per project, per country, per industry. Everything matters in terms of the nuance here. But overall, you can imagine that there's sort of a tipping point where, with sufficient tariffs and sufficient sort of sticks, basically, to motivate Chinese companies, yes, in the end, say consumers in Brazil might end up facing slightly higher prices. I think this is part of the logic too for Trump's tariffs, if there's any underlying logic, but that it would be worth it because it would have brought some manufacturing to those countries themselves, including from China. So on the whole, you can imagine a sort of like a tipping point where, even though the prices are higher for everyone, Chinese companies are incentivized to make the move.
Right. So yeah, last question before we wrap up, and then more of a meta question, like just zooming out. This is just one take that I had that we were discussing internally. But when Deng Xiaoping sort of opened up and China opened up under him, and then from there onwards was the 1990s, where there was a collapse of the Soviet Union, and there was more of globalization. Would it be correct to characterize that China sort of pushed or helped, further this globalization, but because of its restrictive policies in the domestic markets and all of that, it has now come to a position where China itself is now pushing deglobalization, or resulting in deglobalization to some extent? Would that be a good characterization of how it has panned out over the last 30, 40 years?
Yeah, I mean, I would say that maybe the underlying trend that ties all of this together is ultimately that China's doing everything it can for its own national development, to put it frankly. At a time where the global trading system seemed more open, and China was also really desperate for not only economic growth, but for technology and skills, that in that case, China, supported and took advantage of this more open trading system, and try to, again, as I mentioned, invite foreign firms to come in and basically help upgrade Chinese industry. Now, the situation's quite different. And I think what hasn't changed is that China is still trying to focus on its own, long-term, what I call like sort of technological and economic development. It's not just about sheer GDP growth. The age of 10% plus GDP growth is over in China for sure. But now I think there is a stronger focus from Beijing policymakers on trying to move up the value chain, trying to basically tackle these emerging industries even. I mentioned EVs before, but also industrial automation, autonomous vehicles, autonomous systems, drones, space is a huge area, biotech, even going into quantum computing and nuclear fusion. So there's a ton of effort to continue to push sort of China's national development. But in an age of sort of growing backlash to, say, being flooded with Chinese goods and fears about an imbalanced relationship or an unfair trading relationship, I think you get a response from China that looks different, but is ultimately, I think, underpinned by some of the same long-term goals.
Yeah. Just before you leave, your book is going to be on rare earth minerals or something of that sort, right? So any thoughts on where that industry is going in China and worldwide? And China's impact on the clean energy sort of scene, right? I mean, it's a little paradoxical there. It's also leading in maybe clean energy, but also there's the climate change impact that China has, right? So any parting thoughts on that?
Yeah. So, I mean, it's still a large question of like what role China will play, not just in producing, so-called green goods, products that are required for decarbonizing and helping with the broader global clean energy transition, solar panels, wind turbines, EVs, batteries, things like that. But also about whether China will help to develop other countries' abilities to produce some of these same products. So I mentioned earlier, solar panels. A lot of Chinese solar companies had moved some of their manufacturing to places like Vietnam and Thailand, largely really to get around tariffs to places like the US. And there's a question there about how much technology, how much real sort of core knowledge was transferred to these countries, or whether how much of that was really dependent on Chinese polysilicon production and Chinese solar cell production that was then shipped as parts for final assembly into these other countries. So, yeah, I would just say that I think it's still an open question. There are probably reasons to expect, on the one hand, China to leverage some of its capabilities in, say, rare earths for geopolitical reasons, as a tool for either retaliation or coercion, or however you want to put it. But part of the geopolitical toolkit, I would actually put other export control restrictions that China has started to implement in a different category. Like, what's made a lot of headlines recently is, a growing list of EV and battery technologies that are being put on China's export control list. And I would actually kind of put that more in the category of what we were talking about earlier, where China's trying to retain some of the core technology and create a framework where it would be able to allow Chinese firms to set up manufacturing abroad in a way that Beijing would be comfortable with. I think that if they didn't have this kind of framework, Beijing might be reluctant to let any of these Chinese firms do this kind of thing for fear of losing the hold on that technology and the advantages that come with it. But, arguably, maybe this is an over-optimistic perspective, but arguably this framework actually allows for greater sort of global integration of Chinese production of, these so-called green goods. So that could be, that could be a potential upside. And of course, I mentioned, it's all, the devil's in the details. It all depends, perhaps more importantly, on the willingness and ability of countries like countries in the EU, countries like India or across Southeast Asia to push back and try to pull, like China did, some of the knowledge, some of the technology, and use that to upgrade their own industrial systems.
Right. Great. Thanks, Kyle, for this wonderful, insightful discussion. I'm sure our listeners would have enjoyed it. Thanks for taking time out for this podcast.
Absolutely. My pleasure.
Yep. Thank you.
If you liked our show, dive into Takshashila's research on technology, strategy, and economic affairs. Check us out at our Twitter handle @TakshashilaINST or our website takshashila.org.in.